During the past weeks, global banks have suffered a mind-boggling loss of almost $1 trillion. To give you an idea of the scale of this situation, you could fund NASA for over 4 decades with that much money. Bank stock prices are dipping, and economists are predicting that the Fed will likely keep interest rates high despite the turmoil. This crisis is unfolding at lightning speed, leaving small and mid-sized banks particularly vulnerable, and larger banks tightening their belts and reducing lending. In this video, we'll uncover how this banking crisis could potentially destroy small and mid-sized banks and wipe out $7 trillion on uninsured deposits. Every decade or so, we are reminded that men in power seem to never learn from their mistakes. The saying, "too big to fail," has been proven wrong time and time again. It was true way back in 2008, and it's still true today. Just think about it. In just the first 48 hours of this recent banking crisis, led by Silicon Valley Bank, the market lost over $80 billion. But in order to truly understand the magnitude of this crisis, we need to take a step back and analyze how we got here. As you well know, one of the primary ways that banks invest your deposits is by lending your hard-earned cash to individuals, businesses, or even governments. In exchange for these loans, the bank earns interest, a tidy sum that generates income for the bank and provides a return to you, the depositor. But that's not all. Banks also invest a huge amount of their deposits in a range of securities, from government and corporate bonds to stocks. Each of these investments comes with its own level of risk. That's why banks tend to mix and match their investments based on their goals and the amount of risk they're willing to take on. It's a high-stakes game, and one that has a huge impact on the economy at large. Here's why. During the last few years, many banks, including Silicon Valley Bank, purchased numerous bonds taking advantage of rock-bottom interest rates. By the end of 2022, Silicon Valley Bank had 57% of its assets tied up in bonds and other securities. Bond prices and interest rates have an inverse relationship, which means that when interest rates rise, the value of existing bonds falls. Why? Well, because new bonds that offer higher interest rates become more attractive to investors, making older bonds with lower interest rates less appealing. And as a result, the prices of existing bonds decrease in order to stay competitive with the new ones. That's essentially what happened to Silicon Valley Bank's assets. When inflation started getting out of control last year due to an overheated economy, the Federal Reserve increased interest rates 8 times to combat the highest inflation in generations. This made newer bonds more attractive to investors than the ones Silicon Valley Bank had purchased, causing the bank to lose money. As a result of the interest rate hike and the slowdown in the economy, Silicon Valley Bank's deposits stopped growing and began to shrink. In order to gain liquidity and raise capital, the bank decided to sell a lot of its existing bonds, worth around $21 billion at the time, and purchase securities with higher yields and shorter maturities. However, the bonds it sold forced the bank to recognize $1.8 billion in market value losses, which caused concerns around its shareholders and some of its clients. This led to the bank's collapse after just one day of stress, following a classic bank run in which depositors demanded up to $42 billion in a single day. Overall, the Silicon Valley Bank failure has created a ripple effect in the industry. Just a few days after the Silicon Valley Bank's crash, the biggest collapse since Lehman Brothers, Signature Bank was seized by regulators after depositors demanded 20% of all its deposits. Also, due to the confidence crisis in the banking sector, 166-year-old Credit Suisse had to be sold to UBS, its longtime rival, as the bank reportedly faced cash withdrawals of approximately $10 billion. More recently, Deutsche Bank's shares also dropped drastically, and Silvergate Capital, which provided funding for the crypto industry, was forced to shut down and sell its assets due to the ripple effect caused by Silicon Valley Bank. After the bank failures, the Federal Reserve and the U.S. Treasury announced a bank bailout program. But while the bailout addressed the immediate crisis, it did not fix the underlying problem, the fact that the entire economy is built on artificially low interest rates due to the overheated economy of the past years. The government's decision to keep increasing interest rates, even after the banking turmoil, implies that interest rates are unlikely to decrease in the near future. In this scenario, banks may find it difficult to attract and maintain customers, since banking investment instruments do not offer attractive returns at the moment, putting pressure on their cash flow and liquidity ratio. In an attempt to raise capital, Banks, especially smaller ones, may have to sell their bonds and securities in order to meet the needs of their depositors. But, as we have learned from Silicon Valley Bank, this could be risky, as such banks may have to sell their bonds and securities at a loss, adding fuel to an already burning banking sector. Moreover, as we well know, high interest rates make borrowing more expensive and, as a result, increase the risk of default. Due to the above, banks are becoming hesitant to take risks and restricting borrowing, which could lead to less economic activity and could contribute to deepening the banking crisis even more. The banking crisis and its effects on the industry have also raised concerns about the power dynamic among big banks. Swift government intervention, such as the recent bailout, may create a perception that larger banks will also receive support in times of crisis, regardless of whether their deposits are insured. This perception could lead to bankers managing uninsured accounts above the $250,000 cap to take greater risks, or their clients may not examine their decisions as closely. Same was the concern in 2008 when big banks like JP Chase were bailed out. However, right now there's too much at stake. Uninsured deposits account for almost $7 trillion, the highest in history. In the worst-case scenario that the government does not give bailout support and banks continue to tremble, that $7 trillion on uninsured deposits could be wiped out. The risk perception of the banking industry has also raised concerns of migration from smaller regional banks to larger ones, which could eventually cause more small and mid-sized bank closures, leading to fewer lenders holding more influence in the industry. It is true that the current banking crisis affects small and medium banks the most. But as JP Chase CEO Jamie Dimon said, any crisis that damages Americans' trust in their banks damages all banks. As we have seen time and time again, there is no institution out there that is too big to fail. After all, history has shown us that even the best laid plans can go very wrong very quickly. The recent banking catastrophe has sent shockwaves through the industry, causing substantial financial losses and a sense of fear in the market. With economists predicting that the Federal Reserve will likely keep interest rates high, it remains to be seen whether more bank runs will follow. As always, it is essential to remain vigilant and prepared for any potential financial crisis that might lie ahead.